audit evidence. Okay, so this topic is basically a very long one. So lengthwise, you can say yes, one of the longest that you have for your syllabus. But the understandability here is quite simple. It is not a difficult one to grasp the topic as a whole. So here we are going to study something which we have touched upon every time, because whenever we discussed about audit, when we spoke about obtaining a reasonable assurance, every time I told you that the auditor is required to obtain sufficient appropriate evidences. And based on those evidences only, we are going to give our opinion. When we spoke about fundamental principles, okay, of the auditor, I spoke about integrity. I spoke the next one about objectivity. When I told you that the entire or the total opinion which the auditor comes to, it should purely be based on the evidences that he is obtaining, and there should not be any other reason for him to give any other kind of opinion. Correct? So the evidences are going to play the most important role when you talk about opinion. Okay, so whatever opinion you give, whether you give true and fair, whether you give modified opinion, whether you give disclaimer, whatever it is, purely you require to have evidences based on that. Obviously, disclaimer, there'll be the only reason you give disclaimer is you don't have evidences. Correct? Right. Otherwise, basically everywhere, be any kind of other modified opinion like adverse, qualified, everywhere, the reason why we are giving this kind of modification, or the reason why we end up giving a true and fair view, the only thing is that we have obtained evidences to support our things. Okay, now, when we talk about audit, we are talking about reasonable assurance. So that has to be a high level of assurance. So it cannot be that you obtain any kind of evidence and then come to a conclusion that yes, this is what is done and we give the opinion. No. When it comes to audit, because we need to obtain reasonable assurance, because the responsibility over us is very high, the standards itself make it very clear that the auditor requires to obtain sufficient appropriate audit evidence. So we don't require evidence to give opinion. We require sufficient appropriate evidences to give our opinion. So I cannot say that I check only few transactions and what I get an understanding from the few transactions, based on that I'm going to give the opinion. That is not done. Okay. To give a simple understanding here, if you remember, we have done one of the evidences like written representation. Remember? So when I told you that auditor, whenever there is a responsibility of the management, you can also obtain from them in writing that they acknowledge and understand their responsibility. Correct? Now tell me, this particular evidence, if I take this alone and I give opinion, can I say my opinion is reliable for you?
No.
The reason, see, the thing is, I'm telling from management, you take a particular evidence and only with that evidence, you're giving opinion. But is it sufficient, appropriate evidence for us?
No.
We are going to understand what do you mean by sufficient, appropriate audit evidence. Okay. What is sufficiency? What is appropriateness? Okay. Once we understand them, we are going to understand what is the procedure through which we are going to obtain evidence. Understand, audit is nothing but performing the procedures. And why are we performing the procedure? Just to obtain evidences. And based on these evidences, we are going to draw the conclusions. Correct? So the simple methodology is to obtain evidence, we perform the procedures. So what are the procedures that we are going to discuss? After that, we are going to understand, is there a possibility for us to obtain evidences from some other sources also? Like we have using the work of others. Okay, like sometimes it is possible that internal auditors will help you to get the audit evidences. Sometimes some experts will help you to get evidences. Sometimes other auditors like branch auditors and all will help you to get evidences. So we are going to study the entire, whatever is available with us with regard to evidence. Everything is captured in this particular topic. And that is the reason when you look at the length of this particular topic, it looks very high or very long. But trust me, the content is so understandable. It is so nicely given in this book that the understanding will be very, very clear. So in this chapter, as I told you, we are going to understand the need of obtaining understanding of the internal control. That is fine. Obviously, we need to understand the internal controls. Then assertions and the audit evidences. What are assertions? This class I'll be explaining it to you. What exactly you mean by the terms assertions. Many a time we came across the word assertion, but what basically you mean by assertions, today you'll be getting like a proper knowledge about it.
Okay.
Then about audit evidence, we get introduced. Then I told you to obtain audit evidences, you have to perform the procedures. So we'll understand about the procedures. Then one of the important audit procedure is audit sampling and the other means of testing. So here we'll understand what is the way through which we perform these procedures. Correct? Then automated tools and techniques, a completely different study, because we're going to understand if suppose it's a technological industry, like IT environment is used there, then in that case, how audit is to be performed. And then the work of the others could mean experts, others could mean internal auditors. If suppose you're a parent company, you have a subsidiary company, sometimes you require the auditors of the subsidiary company also to assist you. So that is called as the work of the others. Okay. Somebody who's connected to your component or to the business relationship of your client. Okay. So that will come across when we reach the sixth part of this particular topic that I will discuss in detail. Okay. As of now, we get on to the basic understanding of the topic, which is quite simple here. Okay. So first is qualities about the audit evidence. We're going to understand it quite easy. It is sufficient, appropriate. What do you mean by the word sufficient? What do you mean by the word appropriate? Then assertions is going to be one of the important discussions that we're going to have today. Procedures is going to talk about the ways in which you're going to perform it. How to select the items for testing, that is how samples are chosen, we are going to study here. Using the work of the others, and then automated tools and techniques. So with respect to audit evidences, see, everything here is going to give you evidence only. Okay. So all of this we are going to understand through this topic of audit evidence. Okay. So as I told you in the beginning, the standard name and the number, it is ISA 500. Okay. Okay. So ISA 500 audit evidence states the objective of the auditor in terms of gathering evidence. Okay. It says to design and perform audit procedure in such a way to enable the auditor to obtain sufficient appropriate audit evidence so as to enable to draw reasonable conclusion on which the auditor's opinion is based. Okay. See, look at this. The entire audit procedure will be how audit is conducted. To understand it properly, first you enter into engagement. Then first you do is the audit planning. In the plan, you think about how to assess the risk, how to apply the further audit procedures, etc. Then you start performing the procedures. From the procedures, you will obtain audit evidences, and from audit evidences, you will get the opinion. Correct? That means audit evidences will help you to draw conclusion, and all the conclusions taken together, you will get what? Opinion. Correct? Now, keeping this chart in mind, look at the meaning of what they're saying. Audit evidence states the objective of the auditor in terms of gathering evidences to design and perform audit procedures. So to design and perform audit procedure. In the planning stage, what do? You design and perform the audit procedures in such a way to enable the auditor to obtain sufficient appropriate audit evidences to enable him to draw a reasonable conclusion based on which the audit opinion will be given. Okay. Got it? So we are telling in a very, very simple language. Okay. Okay. So just a simple understanding. I'll do it once again. Okay. So the entire audit procedure is going to be simple. We say that you first do the planning of the audit. In the plan, you decide the procedure. In procedure, after performing the procedure, you obtain audit evidences. Every evidence will get you through a conclusion. And then you take up all the conclusions together and you give the opinion. Correct? So basically, if I want to define or I want to need to understand the objective of this audit evidence is what? The auditor is required to plan and perform the procedures in order to obtain what? Sufficient appropriate audit evidences, which will enable him to draw a reasonable conclusion based on which he's going to give his opinion. Got it? So that is the meaning. Now, here they are not saying that the auditor should obtain audit evidence. They are telling he needs to obtain sufficient appropriate audit evidence. So every time in audit, whenever you talk about evidences, you never simply call it to be evidence. You always call it to be sufficient and appropriate. Now, the meaning of the word sufficiency relates to quantity of the evidence. Appropriateness is a very interesting discussion which talks about quality of the audit evidence or the relevance or the reliability of the audit evidence. Okay. So what they're saying is, suppose if there are going to be around 10,000 sales transactions. Okay. Now, in that case, obviously, when it is 10,000 sales transactions, you just cannot pick up one or two transactions and tell that the sales are free from material misstatement or not. So basically, the way in which you are going to check the sample size that you're going to choose, everything should be appropriate for the given circumstances. When will I say sufficient? I will say sufficient when the quantity of the evidence which I have taken is so much that I'm able to draw a reasonable conclusion that yes, sales could be free from material misstatement or not. So if there are 10,000 sales transactions, just taking one or two will not call it to be sufficient. Got it? Similarly, appropriateness is going to talk about in sales. There are going to be multiple aspects that I'm going to check, like whether it belongs to the particular year, okay, whether it is correct by the accounting treatment, whether amounts are recorded correctly or not, correct? Whether I'll check the measurement, I'll check the occurrence, I'll check everything. So basically, it has to be relevant for the assertion that I'm checking. If you just remember, just go back a little and we spoke about audit risk. Okay, if you can remember the discussion of audit risk, then if you remember one example we had done where we were talking about debtors recoverability, correct? There we understood that the procedure that we perform, we need to take into account what are we actually finding or what are we settling. Is it completeness or is it, the measurement? Is it the valuation of the debtors? What are we checking? So based on what we are checking, that should tell me whether my evidence is suitable for the checking or not. If I'm checking completeness and if I get evidence regarding valuation, then it makes no sense. If I want to ensure sales are recorded correctly, that means total sales are recorded. That means I want to check whether sales entry is complete or not. In that case, why will I check valuation? Got it? Or you can say measurement here. Okay. So in that case, whatever is the assertion, okay, based on that assertion, you have to decide that the evidence what you have found is satisfying the assertion that you are checking. Okay. So both will be important. It should be sufficient enough and it should be appropriate for the given checking that you are doing. Okay. Then now we have a discussion regarding sufficient evidence. Okay. Now the auditor needs to gather enough evidence to form a conclusion. Enough as in quantitative. This is a matter of professional judgment. When determining whether there is enough evidence, the auditor must consider risk of material misstatement. Now tell me if this area is a particular which is having more risk. So will you choose a larger sample size or small sample size?
Larger sample size.
Large. Why? Because you require enough evidences to satisfy yourself that yes, it is free from material misstatement or not. Correct?
Yeah.
Then materiality of the item. The more material the item is, the more checking will you do. Correct? Then the nature of accounting and internal control system. Internal control systems are strong. We will do less sampling check. Samples will be less. If internal controls are bad, we'll have more checking to be done. The results of control test. Control test is nothing but you have tested the controls. After checking the controls, if you believe controls are very good, then maybe the checking will be less. But if the controls are bad, checking will be more. So based on that, I will decide how much evidence will I require. If controls are good, I don't require many evidences. Few will be enough. If controls are bad, then I require enough evidences to satisfy myself whether they are free from a statement or not. Correct? Then the auditor's knowledge and experience of the business. If it is a recurring audit and from the last 4 to 5 years, you have been the auditor, obviously you will get getting an idea very clearly how much evidence will I require to satisfy myself. Correct? So your experience also will play a role. If it is completely new, you will check more transactions. If you are already having enough experience with the client, then maybe your sample size will be smaller, depending upon your experience with the client. Size of the population, the bigger the population is, more checking will be done. Correct? Not only the size, also the nature. If the population is material, then in that case also you're going to check more of it. For example, if you're checking related party transactions, this by itself is very important. So you will do the checking in detail. So here what we're telling is how much you require to check will depend upon all these factors. Then the size of the sample selected for testing. If already you have chosen a small sample size, okay, then in that case, more checking you'll be doing. Correct? Then the reliability of the evidence is obtained. Now this we are going to do a detailed discussion because reliability as in how much can you trust a particular evidence. Okay. Now just to give a simple understanding, suppose if you are getting evidences from an external party, okay, and if you are getting evidence from internal source, that is employees, which you will consider to be more appropriate?
Definitely not the one from the internal.
Correct. Why? Because internal could be manipulated.
Yes.
So I would say if it is internal, I would require maybe 20 evidences. But if it is external, I believe it to be reliable. So I would require one evidence enough for me. So how much is going to be enough for you is purely the professional judgment of the auditor. And this will depend upon all these things.
Yes.
Got it? So that is the meaning of this, that you have to understand it should be enough evidence. Why? What enough? We are saying that this much should be enough for us to obtain what? Reasonable assurance. That means this much is sufficient for us to give a reasonable assurance. Got it? So that will be dependent upon all these criteria and these are quite understandable. Okay? Then now comes to the important one. They have given a very nice example here. Consider the audit of bank balance. Okay? Now look at this. We require sufficient evidence. We'll not read it first. I'll just explain you what they're telling you. Now, bank balance, according to you, okay, we say, let us take 31st December is the year ending. Okay, and you're performing the audit. So obviously, when you want the bank balance, the way in which you're going to obtain the audit evidence regarding the correctness of the bank balance is that first thing you could try and get directly from the bank. So you can get the confirmation from the banks directly. What is the outstanding or what is the balance as on 31st of December? So you will get a number. Okay, now tell me, is this enough for you to decide what is given in the financial statement is correct or not? Is this enough? Like, for example, here it is standing as maybe $1 lakh. Okay. And the bank has given you the intimation of $80,000. Now tell me, only because bank replied you it is $80,000 and your books are showing 1 lakh, will you say bank is correct and books are wrong? Will it be enough evidence for you to confirm that bank is materially misstated? Bank balance
Yes,
here is materially misstated. Is this enough evidence for you to give? The answer is
from bank confirmation, right?
yes.
Yes, I think yes, it is sufficient, right?
No, but tell me, there could be possibility that on 31st December also you made transactions, 30th December also you made transactions, and there could be a possibility that banker did not clear it for you. Maybe the checks are still in process. Maybe the acceptance by the bankers have still not happened. Sometimes there could be a clearing cycle also. So that is the reason we prepared something called BRS also.
Yeah, bank reconciliation.
Why is BRS prepared? Because timing difference will come between the cash and the bank books.
Okay.
Correct. So bank obviously will tell you that balance which is appearing as per their books. But there could be possibility on 31st December, there has been a sale for which there has been inflow, which you have already credited to your bank, but the bank has still not accepted it. The clearing has not happened of this check. So obviously in the bank, this reflection of the account will not be there. Understanding? So bank, suppose the entire 20,000 difference that is coming is because of the sale. So obviously in my books, it is appearing because I already recorded the sales in my books. But now bank has not cleared the check only still. So bank does not have it in its account. So that is the only reason we prepare BRS, right? At the year end. Or maybe after quarter end or fortnightly, whatever is the cycle. Why we prepare the BRS? Just to reconcile the figures between the bank and the cash. And that is with you. So bank account which you maintain and what the balance with the bank is, to reconcile it, we prepare the BRS every time. So now here I cannot say that only the bank statement is enough evidence for me to tell whether bank balance is misstated or not. I will, along with the bank statement, also ask the company to show their BRS in order to understand, is there any timing difference for any transactions in the cash book and the bank book? If that is the case, then that means we will reconcile and check whether the figures are matching or not. And after reconciliation also, if there appears a difference, then in that case, we will say, yes, they are materially misstated. Okay. Now read the entire thing, will follow. Consider the audit of bank balance. Okay. The auditor will confirm year-end bank balance directly with the bank. So this you understood? This is a good source of evidence, but on its own, it is not sufficient to give assurance regarding the completeness and the final valuation of the bank and the cash amounts. The key reason is timing difference. The client may have received cash amounts or checks before the end of the year, or may have paid out the checks before the end of the year that have not yet been cleared in the bank account. For a simple example, suppose today is 31st of December, suppose you have given me a check. You came to my office and you gave me a check. This check today I deposited in the bank. Okay. Right? So in my books, which I maintain, okay, my accounts, I've written bank account debit, okay, to your name will be written here. Okay. So this is basically, I have already registered in my books. But now in the bank, after it is cleared, only bank will reflect it. Okay. So this clearance, maybe it happened on 1st of January with the bank. Okay. Now imagine on 31st of December, if you look at the two things, in my books, okay, this money is supposing to be $10,000. If suppose in my books, it is appearing to be receipt of 10,000. In banks, it is not there. So there is obviously going to be a difference. And this difference is not misstatement. It is timing difference. So your banker, when they will give me the details, I will get 10,000 less. When you give me the detail, I will get appropriate 10,000. So now this I cannot consider it to be what? Material misstatement, only because bank has told me. So what will I tell? Look, also give me BRS. So that I understand what is the timing difference or which transactions have got this reconciliation problem. Okay. Then when I reconcile and I will see, this was the transaction which happened on 31st. Bank has still not cleared. Bank will clear it later on. That means it is adjusted properly. Then in that case, I can say whether misstatement is there or not there. Okay. So here the point is only the bank statement is not enough for me to obtain a reasonable assurance. Along with that, I require something more, which is BRS. Now, this two together will say what? It is sufficient evidence.
Sufficient evidence. Okay.
Now you got the point?
Yes.
Okay. Now the client may have received cash amount or check before the end of the year, or may have paid out the check, like salaries are already paid. So in my books, debit will appear, money is gone out, but maybe the employees will clear it later on. Got it? So in the bank, the money will remain as it is, but in my books, I've already debited it. So there is going to be a difference in the balances, but that is not misstatement, that is timing difference. Correct? For this reason, the auditor should also review and reperform the client's year-end bank reconciliation. In combination, these two pieces of evidence will be sufficient to give assurance over the bank balance.
Okay.
So one will not be sufficient. Here, two things will become enough for him to give a reasonable evidence.
Okay.
Got it? All right. Moving further, we talk about appropriate evidence. Appropriateness of evidence breaks down into two important concepts. One is reliability, one is relevance.
Okay.
Okay. Now, reliability simply says the source from where you get the evidence should be reliable. Okay. Now, suppose I am looking into sales and this client has given me a particular record. Okay. Maybe sales invoices are given to me, but every sales invoice is a Xerox copy, is a photocopy. Are you going to trust this or are you going to ask them for the original?
Original, of course.
Why? Because you believe the reliability of this evidence is more than the photocopies.
Yes.
Correct? So when will I say that I have appropriate evidence? When they are reliable. Got it? Or suppose if I'm telling there is suppose there is a possibility that the auditor can obtain one particular evidence directly from the third party. There is one more evidence where auditor has to route through the client and obtain the evidence from the third party. Now tell me which is more reliable. Auditor obtaining directly?
Direct. Yeah.
Directly. Why? Because client is in between here. Manipulation will happen. Correct? Yes. So based on these criteria, we are going to decide whether the evidence we have got is reliable or not. If it is not reliable, it is not appropriate. I can't give my opinion based on something unreliable that I have. When I only don't trust on the evidence, how can I tell it is appropriate for me? Got it? So first we talk about reliability. Okay. Then we talk about what is relevance. But first we discuss entirely about reliability.
Reliability.
Okay.
Right. Yeah.
Now, the auditor should always attempt to obtain evidence from the most trustworthy and dependable source possible. Most trustworthy, abstract, dependable source, we can say. Okay, but this trustworthy in the business world always becomes a big question mark. Okay, so you don't know who's actually trustworthy inside the organization. Okay, but then we can still find out to our level best because we are also professionally skeptics. We'll be quite alert in understanding who is what. Okay, now, evidence obtained from an independent external source is more reliable than client-generated evidences. Why? Because client-generated evidences are always scope for what? Manipulation. Correct? But external sources, like to give simple example, out of sales invoice and purchase invoice, okay, which you think is internally generated?
For sales, is it?
Yeah. You do sales and you do purchase also, right?
Yeah.
Internally is which generated one?
Sales invoice.
Sales.
Yeah.
Purchases somebody else will give you. So to check purchases, purchase invoice would be appropriate.
Yeah.
But every time to check sales invoice need not be appropriate. Okay. Because they have been done by what? Internal.
Okay.
So purchase invoices you can trust because it's coming from the external party.
External party.
That you don't have you cannot have a control over it. But sales invoice you have complete control. So purchase I can check through purchase invoice. But sales every time I cannot check by sales invoice. But if I want to check sales invoice, I will check whether internal control is very strong on sales. Mm-hmm. If internal controls are strong, means internally generated invoices could be correct. Got the point? Okay. Evidence obtained from an independent external source is more reliable than client-generated evidences. Then, evidence obtained directly by the auditor is more reliable than evidence obtained indirectly. Indirectly means through the client. Okay, then client-generated evidences is the least reliable source of evidence. I already told you, when client is generating any evidence, it is least reliable. Don't trust it. Manipulation will happen. If the client is manipulating the financial statement figures, they may produce fictitious evidence to support the figures. Simple example, if suppose this year you want to take a loan, so you want to show more and more profits. So what you did, you increase sales. Now sales invoices are generated in the organization only. So how much time will it take for me to come up with fictitious invoices? I simply have to click on the print button. Are you understanding? So this sales invoice, do you think it is going to be a reliable source of evidence for me? No, because it is easily manipulated. Because if the management wants to alter the financial statements, internal generated evidences can be easily done. Okay, manipulation can easily happen. Client generated evidence is more reliable if effective controls are in place. I explained you this. Correct? Then this doesn't mean the auditor should not rely on client generated evidences. It simply means that where more reliable evidence is available, the auditor should obtain it. Okay, see, you cannot say, no, evidence obtained from the client, not appropriate, cannot be there. Because see, everything we can't get externally. Internally things we have to check only. So it is impossible that everything has to happen out externally, but obviously we need to be double sure for internally generated. So we do internal control checking. Got it? Then, in addition, written evidence is more reliable than oral evidence. Okay, we live, okay, in an era where today what you say, tomorrow you say, I'm not told. Okay, so obviously you do not rely a person who is giving you oral evidences, or maybe do not consider oral to be most appropriate evidences. Inquiries also, whatever you do, try to take it in writing, because written evidence is always more reliable than oral evidence, as oral representations can be withdrawn or challenged. Anybody can say, I never told. Anybody can say, I thought like that. Okay, anybody could do any kind of challenge over that. But written is something somebody is confirming. So always prefer to get written evidences. Then this I explained it to you. Original documents are more reliable than copies or documents transferred into electronic form, as it may be difficult to see if these have been tampered. Okay, very simple. If there is a sales invoice, okay, and suppose it is written as 10,000, okay, maybe comma is not there, and I simply added one more zero. And if I take a photocopy of it, which is, maybe it is a black and white photocopy. Okay, so in that case, obviously the pen difference won't come. So this 1 lakh which I've made, you will never even know it is altered figure. So that is the reason we always insist on what? Original. Because if there is a tampering on original, you can find out. But on photocopies, printed copies, you can't find out. Okay, so that's very important. So this is regarding reliability, a very simple discussion. So we are doing ISA 500. So in ISA 500, it is discussing the topic of appropriateness. In appropriateness, we are doing first the reliability. Correct? In reliability, we are saying external sources are more reliable than client generated. That is nothing but internal. Correct? Evidences obtained directly are more reliable than evidence obtained indirectly. Least reliable are the internal generated, because manipulations can happen. But obviously, you can check the controls, and you can never say that we will not at all rely on them, because there are certain evidences which will come internally only. Okay, but you also have to be double sure by checking the internal controls. Written evidences will always be more reliable than oral evidences, and originals are always preferred over photocopies or electronic medias. Okay, then. Broadly speaking, the more reliable the evidence, the lesser of it the auditor will need. However, if the evidence is unreliable, it will never be appropriate for the auditor, no matter how much it is gathered. Okay, the meaning is, if I say enough, okay, that means if I'm telling sufficient evidence, your sufficiency will never get satisfied if you're not getting reliable one. If I get 10 tampered copies, can I say 10 are enough for me to check? No. When these are only not reliable, sufficiency is never met, because you'll go on checking and checking and checking and checking unless you get what? Reliable. Correct? So once you get reliable, then you understand how much. So sufficiency is something that depends upon the reliability. If you quickly get a reliable source, then that is enough for you. But if you're not getting reliable absolutely, then go on checking, checking, checking unless you come to a situation where you feel it is enough. So basically, sufficiency purely depends upon reliability. Okay, moving to the next one, relevance. Okay, relevance purely you will understand only when you get the concept of assertions. Okay, we are going to do it after some time, but still then, but even then, I'll give you an introduction to what is assertions. Every now and then we come across the word auditor has to check the assertions or validate the assertions. In a simple language, to understand what assertion is, that management claims something. Auditor has to tell whether this claim is correct or not correct. This is nothing but he's doing audit. To give simple examples, suppose there is a balance sheet. Okay. Suppose there is a balance sheet. In the balance sheet, building is appearing at 10 crore. Here the meaning is this 10 crore is given to you by the management. That means management is claiming that building is worth 10 crore. Management says we have the building. So these what the management is claiming. We call it to be what? Assertion. Because who prepared the financial statement? Management. So whatever is available in the financial statements or whatever is explicitly told by the management, we consider it to be what? Assertion made by the management. And audit is nothing but what? To validate the assertions made by the management. So if management has given in the financial statement 10 crore as the value of the building, obviously it is understood indirectly that they're telling building is existing. If the building is there, that means the ownership of the building is with the management. That is the client. So ownership, okay, existence, valuation of the building, all these are assertions made by the management. Now, when I'm doing the audit, my point of view is, or my understanding is this, whatever assertions management is making, I need to validate. That means I will check whether building is present. I will check whether building's valuation is 10 crore. I will check whether really the client is the owner of the building or not. So what I do as a part of audit, I'm validating these assertions. And for this, what I require? Sufficient, appropriate audit evidences. Correct? So what will I say? Suppose if I'm checking whether 10 crore, okay, if I want to tell whether 10 crore is correct or not. Okay. Now in this case, if I want to understand whether the value of the building is correct, I want to check valuation. So which assertion am I checking? Valuation. Now in this case, obviously, I am not going to contact the external party and ask for the, okay, maybe I will contact them and I'll ask them, did they sell and what price did they sell? Or I would check into the purchase, that is the title deeds, to understand the sale price. Okay. If I want to look into the existence, okay, what will I have to check? If I want to look into the, ownership, then I'll ask for title documents. Correct? For ownership, basically, I look into the invoice or the title document to understand whether really the client is owner or not. So based on what I am checking, based on that, I have to pick up the evidence. So basically, I will call it to be relevant only when the assertion which I am checking, it should be validating that assertion. So when I'm checking valuation, I should obtain evidence to tell me the valuation is correct or not correct. If I'm checking for existence of the building, then in that case, I have to actually go and do physical verification. I have to go to the client's location and check whether building is there or not there. Correct? So this is what I'm doing. I'm observing and obtaining evidence. So what evidence I'm obtaining, it should be for the relevant for the assertion that I'm checking. It should not be that I go to physically verify to understand whether valuation is correct. If I want to value the particular building, can I look at the building and do the valuation? Absolutely not possible. So there what I will do is, suppose I need to do the valuation of the building, understand the valuation, I'll ask for the purchase document, I'll ask for this, or maybe sale deed I'll ask. And if I want to know about the ownership, I'll ask for the title document. I will not go physically and verify the building and to understand the valuation. Are you understanding? So if I want to understand the existence, I will do the physical verification. Understanding? So whatever assertion I am validating, for that assertion, I require to obtain the sufficient appropriate evidence. So for existence, okay, if I do the physical verification and I obtain the audit evidence, then that is considered to be relevant audit evidence. Is the point understood? Okay. Because if I want to check valuation, if I want to know 10 crore is correct, for that I'm doing what? Physical verification. Now, physical verification is never going to give me valuation. So is it appropriate? No. Got it? All right. So now understand what is relevant. Yeah. Relevance means the evidence relates to the financial statement assertions which are being tested. Correct? For example, when attending an inventory count, the auditor will select a sample of the item from the physical inventory and trace them to the inventory records to confirm the completeness of the accounting records. Now understand, completeness means what? Everything should be recorded correctly in the books of accounts. Nothing should be omitted, nothing should be overwritten. That is called completeness. So what is my assertion here? That in the accounts, whatever inventory is appearing, whether it is correct or not. So what I did, I took a sample from the physical inventory and I traced whether this which is shown in the books of accounts or not. If it is there, that means inventory is complete. But look on the contrary, I am doing reverse. Why? Because my assertion is changed. Now I want to check the existence of the inventory. Existence means what? In the accounts it is given 10 units are there. So what will you do? Now you will physically verify the units to answer, or maybe you will count the units and check whether really it is matching with the 10 in the books or not. Correct? So here select a sample of item from the inventory record and trace them to the physical inventory to confirm the existence of the inventory. So suppose they are telling you material A, 10 units are present. Okay. Now what I will do, I have chosen this from the accounts to check whether this is really there or not there. So I went to the go down and I asked for material A. And material A physical checking I did and I found 10 units. So what did I say? Yes, they are existing. So here I checked the existence and here I checked what? Records. At both the places my assertions were different and the procedures are different. And that is the reason here appropriate evidence is different, here appropriate evidence is different. Got it?
Got it. Yeah.
Yeah. Then, while the procedure is similar in nature, their purpose and relevance is to test different assertions regarding inventory balances. Got it? See, both are same procedures in reverse order, but both are finding out two different things. And that is the reason you can't interchangeably use them. What we are going to study now is in financial statements, we have three parts. First is balance sheet. Second is P&L account. And third is called as notes to accounts. Balance sheet are nothing but account balances. In P&L, we will have class of transactions. And in notes to account, we'll have disclosures. Correct? So when I use the word account balance, you need to understand I'm referring balance sheet items, assets, liabilities, capital. When I talk about class of transactions, you should understand it is P&L account item, that is income and expenditure. When I talk about disclosure, it is nothing but notes to accounts. Now tell me, financial statement as a whole, who is preparing? Management. Now when management is going to hand over the financial statements to the auditor, don't you think whatever is appearing in the balance sheet, whatever is appearing in the P&L account, whatever is appearing in the notes to accounts are all assertions made by the management? And don't you think as a part of my audit, I'm simply going to validate the assertions made by these people in this particular financial statements? Correct? And exactly. To validate the assertions, I'm going to perform the procedures. And after performing the procedure, I'll be able to obtain sufficient appropriate audit evidences. Is the point clear? All right. Now look at it, okay? The objective of audit testing is to assist the auditor to reach a conclusion as to whether financial statements are free from material misstatement, and this you know very well. Okay, perform procedures to come to a conclusion only. The auditor will perform a range of tests on the significant, look at the language. Significant, class of transactions, and account balances. And I would recommend, do not call them to be balance sheet items. Do not call them to be P&L account items. Use the language of the audit, which we say class of transactions and account balances. Okay, then. These tests focus on financial statement assertions. Now, what is the definition of assertion? It is a representation, explicit or otherwise. Why explicit or otherwise? Explicit means expressed, otherwise means it is implied. Okay, now when I say building, 10 crore. According to your understanding, what have they expressed? That building is there and 10 crore is the valuation. But along with that, if suppose building is appearing in the books of A Limited, that means A Limited is also the owner of the building. Correct? So here two are expressly given. But one we are inferring also. Because it is appearing in the books of A Limited, we also need to check the ownership. Correct? Only then it is correctly appearing in A Limited's book. Otherwise, it cannot come in A Limited's book as the asset. Got the point? So whether it is expressly given or it is otherwise, with respect to the recognition, measurement, presentation and disclosure. So recognition, we understand the language, whether to recognize it as assets or not, liability or not. Measurement, P&L account items are measured. Presentation, okay, we have the financial reporting framework to give us the presentation, and disclosure, that is notes to accounts of information in the financial statements, which are inherent in the management, representing that financial statements are prepared in accordance with applicable FRF. Management says, look, we have prepared the financial statement as per FRF. That is the assertion made by the management. Now, we, the auditors, have to validate whether the financial statements are prepared as per the FRF. And that is what the audit is all about. Is the point understandable? Okay. Now, further, assertions are used by the auditor to consider the different types of potential misstatements that may occur when identifying, assessing, and responding to the risk of material misstatement. See, we could check whether existence could be a problem. We could check whether ownership could be a problem. We could check whether measurement could be a problem. We could check whether valuation could be a problem. So don't you think we are taking all this as a mean for our understanding whether there could be risk, whether there could be misstatement and all that? So these assertions one by one we pick and we check so that we understand whether material misstatement is present or not present. Got it? So this is called as the assertion. Who makes the assertion? It is the management who validates the assertions made by the management auditor, and that is the reason, that is the entire concept of audit actually. Okay, now let us see what are the assertions. Okay, when you talk about balance sheet items, what are the assertions that we check? Let us take building for ourselves. So building appearing in the balance sheet, 10 crore. So what are the assertions with respect to this particular thing which is made by the management? That means management is telling the building is in existence.
Is this like an exhaustive list?
Yes, this is exhaustive, yes.
Exhaustive.
Yes. Management is telling it is existing. Correct? Management tells we have a right over the building.
Okay.
Obligation will be for liabilities.
Right.
Completeness, that means we have recorded the building completely. That means installation expenses, if they were there, we if they were, building expenditure, we capitalized properly. Any repairs which were, very important ones, which increase the life and all that, that we have, properly capitalized. So that means they have completed everything with respect to the building has been written correctly.
Right.
Then valuation of accuracy, valuation, allocation. Allocation, again, capital expenditure, revenue expenditure. Valuation means including depreciation, it is taken up correctly or not. Correct? Accuracy means properly you have recorded, correct numbers are appearing there. Correct? No overstatement, no understatement. Classification, what is non-current asset, current assets, what is it? Then presentation. As per the financial reporting framework, did you present it exactly where it was supposed to be there? Okay, like for example, in India, when you talk about Schedule 3, okay, buildings and all come as a part of non-current assets.
Yes.
Correct? So basically, you need to check whether the presentation is correct. So management is telling, according to them, building is in existence. They have a right over the building. The building is completely recorded in every aspect. Nothing is omitted. We have accurately recorded, valued correctly, allocated correctly. We have classified the building correctly, and we have presented also correctly. Now, this is what they are telling. Now, auditor will perform the procedures and obtain sufficient appropriate audit evidences to ensure the assertions made by the management are correct. And if he comes to a conclusion that what they are telling is correct, we say we have obtained what? Reasonable assurance. That financial statements are prepared as true and fair. That is regarding what? Account balances. Okay, then when you talk about transactions and events, that is basically balance sheet and also notes to account, we can take it because events, subsequent events and all, we give it as disclosure. Going concern, if any problem is there, we give as a disclosure. Correct? Occurrence. Occurrence as in this basically, see, when you talk about balance sheet items, occurrence cannot come because balance sheet is something that we are going to record for a financial position. So building, even if it is purchased 10 years back, it will appear today also in the balance sheet if you have not sold it. Correct? So that is the reason occurrence will not come here. Occurrence comes in P&L account and notes to accounts and all that, because in P&L account it is a period statement. Here only those which come to the particular financial year, like 1st of January to 31st of December, only these transactions can come in P&L account. That is the reason occurrence becomes very important. It should have occurred in the financial year for which the P&L account is prepared for. Got it? So that is the reason occurrence becomes one of the important assertion here. That doesn't come in balance sheet because there is no concept, because in balance sheet, you give a financial position as on a particular date. Correct? Then completeness will come here also because it should be complete in every respect. Accuracy, numerically correct, arithmetically. Cutoff again talks about occurrence only because cutoff means 31st December and 1st January. Proper cutoff has to happen. This year period transaction should not come here. This year transaction should not go here. So you have to ensure cutoffs are correctly done. Classification, again, here also you need to understand which is revenue, which is capital. Based on that, the capitalization is going to happen, or you'll charge to the P&L account. Presentation, okay, that also is given by the financial reporting framework, how we are going to do. So management says only those which occur in the particular financial year we have recorded. They are complete in every respect. They are accurate. We have checked the cutoff properly. We have classified correctly. We have presented correctly. So management gives all the assertions. Now the auditor will perform the procedures and find out whether assertions made by the management are correct or not. Is the point very clear? So these two things you need to understand properly, because there could be MCQ kind of question, objective based question, where they could ask you about which assertions are checked in case of account balance and transaction. So you need to understand the ones which are not present, like occurrence is not here. Cutoff doesn't come here. Correct? Rights and obligation doesn't come here. Are you understanding? Okay, so need to understand properly. See, basically valuation is coming here, but for valuation here, contrary would be measurement. You measure the P&L account items, you don't value them.
Right.
Okay, so that could be one extra thing. It's okay if you add or not add, but it's not given in the book, so it's fine. But measurement is what we can tell. Okay, all right. Now here they explain the same thing again, which I explained it to you. Now reading will be very easy for you. Assertions about classes of transactions and events and related disclosure for the period under audit. Okay, these are regarding P&L account and notes to accounts. Pen is giving a problem. Okay. First is occurrence. The transactions and events recorded and disclosed have occurred and pertain to the entity. Okay, recorded and disclosed, P&L and notes to accounts. Completeness. All transactions and events that should have been recorded have been recorded, and all related disclosures that should have been included have been included. That means no omission, absolutely. Accuracy, amounts and other data have been recorded appropriately and related disclosures have been appropriately measured and described. See, understand here. I told you measurement is the word here. Correct? Then cut off. That is, you need to take care of the year-end transactions. Transactions and the events have been recorded in the current accounting period. Correct? That which belongs to the next year is not bought in this year. That will belong to this year is not taken to the next year. This is basically for sales and purchases, inventory related transactions. Problems could happen. Okay. Classification, transactions and events have been recorded in proper accounts. Okay. So proper grouping of accounts have to happen. And presentation, transactions and events have appropriately been aggregated or disaggregated and clearly described. And related disclosures are relevant and understandable in the context of applicable financial reporting framework. Okay, so basically, just to give you a simple example, when you talk about Indian perspective, okay, we talk about Schedule 3 for the companies as the financial reporting framework. Okay, there when you talk about presentation, okay, one of the important presentations is with regard to audit fee. Okay, so there what we understand is when you talk about audit fee, auditors are also always given fee. Along with that, you also get reimbursement of expenses for the facilities. Correct? So here, as per the presentation norms, you have to show audit fee separate and reimbursement separate. Got it? So this maybe the total figure could be same. So we are not having a problem with valuation. We have a problem with what? Presentation. So both presentation and measurement both have to be correct. Only then we say they are free from material misstatement. Okay. Got it? Okay. Yes, presentation should be as per the applicable FRM. Okay, then about account balances and related disclosure. First of all, existence. Like if suppose management tells loan is there of 5 crore, then whether loan is really there or not there is what? Existence. Assets, liabilities, equity, interest exist or not exist. Rights and obligation. Okay, if the entity holds or controls right to the assets and liabilities and are obligations of the entity. Don't have fake things put in your balance sheet telling you have an obligation and the obligation actually not there. Correct? Then completeness, again the same, everything has been recorded. Accuracy, valuation, allocation. Assets, liabilities and equity interest have been included in the financial statements at appropriate amounts. And any resulting valuation or allocation adjustments have been properly recorded and related disclosures have been appropriately measured and described. That means what? If you talk about building, so you give an amount, gross value, less you also give depreciation, okay, and then you present it correctly. So that is called accuracy, valuation, allocation, everything you have done correctly. Okay, then classification, it has to be properly accounted. In proper accounts, you have to be shown, and presentation depends upon the FRF. So the way FRF is telling you to present the particular data, that is the way in which you present it. Got it? So what has to come under non-current will come under non-current. What has to come under tangible will come under tangible. What has to come under fixed assets will come under fixed assets. What has to go into current will go under current. So that you have to be very careful when you're analyzing and presenting because it should be as per the applicable FRF. Got it? Yes, that is the meaning of the word assertions. Did you get it right?
Yes. Yes.
Now they've given you a very interesting example to understand regarding the different assertions that we can check by performing different procedures.
One specific example here.
Yes. Okay. Now comes to inventory misstatement. Okay. Now we're talking about the inventory, the stock that we're talking about. Inventory basically closing stock. So first you need to understand closing stock comes under what? Account balance. It is not a class of transaction. It is account balance. It is a balance sheet item.
Yeah.
Correct. So here we need to check what? Existence.
First, yeah.
Then valuation. Completeness. Right. Correct. Again.
Price and obligation.
Again, what do you remember? Existence, valuation, completeness, right. Presentation.
Yeah.
Correct. Now.
Yeah.
So basically we are going to check all of this. Now tell me, if you start looking for evidences, you need to satisfy all of this. Now, first of all, to check existence, best option is you do what? Physical verification. So look at the existence. Look at the second point here. Items delivered after the year end could be included in this accounting period. This would mean inventory did not exist at the year end period. Now, this you understood when you did physical verification, you understood items delivered after the year end could be included in this accounting period. Why? Because cutoff also you do, right? Because what they're telling is items have been delivered after the year end. That means you actually purchased. But at the year end, they were still in transit. But understand, once they're in transit, ownership is with you because you already purchased. So actually it should be included in your inventory. But when you looked at the existence, it is still in transit. So in your go down, it is present. No. Did you get the point? If you go to the go down on the 31st of December, you will see that the warehouse doesn't have this inventory because it's still where? In transit. Now tell me, according to you, this which is in transit, can it be included in the inventory or not included?
Should not be included in the inventory.
It should be included. Why? Because when did the purchase happen? Before the year end.
Okay.
That means it belongs to which period?
Okay. Yeah.
They're only in transit, but the sale is already done to you. Got it? So here they're saying items delivered after the year end could be included in this accounting period. This would mean inventory did not exist at the year end date. So as per my checking, I understood that there are some particular items of inventory which are not existing. So did I find out about the existence? Yes. Okay. Then items might not be counted. Okay. And therefore not be included in the balance. This would mean inventory balance was not complete. Items might not be counted and therefore not be included in the balance. This would mean inventory was not. See, there are many ways inventory could be materially misstated. They are giving you examples.
Okay.
So what happens? Maybe a possibility that the physical verification could not be completely done. So few items could not be counted. So that means they're not going to be in the balance. That means the balance is still not complete.
Right.
Got it? Then damaged or obsolete inventory might not be valued appropriately at lower of cost or NRV. Possible. Now, auditor is what we are trying to understand is when you check valuation, what you should focus upon. The thing is, you have to check whether any damaged or obsolete items are there.
If it is damaged or obsolete, it might not be valued.
It should not be valued at the regular things. It should be valued at lower of
net realizable value.
Cost or NRV.
Yeah, NRV.
Right. Yes. Then about valuation, again, what you can check, purchase cost might not be recorded accurately. This would also affect valuation. For example, purchase cost was 10,000. By mistake, the person who wrote it as 1,000. So valuation became a problem.
Yeah.
Then inventory stored at the client's site may belong to third party. The client would not have the right to such inventory in their financial statement. Correct? So maybe you already sold, but the third party has still not picked up. It is still lying in your warehouse. Yes, that doesn't mean this should be included in your inventory.
Yeah.
Correct? And if you include in the inventory, that means valuation, the right is telling that this is not your inventory. That should not be included as a part of your inventory. Got it? So basically the entire discussion is regarding what mistakes could be there in valuation of inventory.
Yes.
There are many ways inventory could be materially misstated.
Risk, basically.
Risk, yes, correct. Absolutely correct. Okay. So your completeness also we got an idea. Existence also we got an idea. Valuation. Also valuation. You're right.
Yeah.
Got it? Then moving further. Now, the same thing that we discussed now, addressing disclosure in the audit of financial statement. Disclosures are an important part of financial statements and seen as a way for communicating further information to the users. See, understand what is notes to account. In individuality, it has no meaning only. You always call it to be what? Related disclosures. That means they're either related to account balances or they're related to class of transactions. So either they are for balance sheet items or they are for P&L account items. So these disclosures, if suppose they're talking about method of depreciation, that means it is pertaining to a balance sheet item and your expenditure in the P&L account. Suppose it is talking about how equity, how did you come to the equity figure? Then the total calculation will be given where? Notes to accounts. So basically what happens is whatever is given here, the basis of the calculation or the basis of the accounting principle or the basis of the policy that you followed or the kind of calculation that you have done is given where? In the notes to accounts. So notes to accounts basically is nothing but it is explanatory to make the financial statement more understandable. Got it? So we say disclosures are an important part of the financial statement and seen as a way of communicating further information to the users. Because if you look at the P&L account and if they have given depreciation is 1 lakh rupee, okay, or it is maybe you can say $5,000 is the depreciation given, then in that case, why, what, which method, everything you'll understand only where? Notes to accounts. So further information is coming from where? Disclosures. Further communication to the users happening from where? Disclosures. And that is the reason without disclosure, these financial statements will be half knowledge, and half knowledge is always dangerous for the end users to understand.
Okay.
Got it? So to get complete information, notes to accounts play a very, very important role. So disclosures have to be there. And that is the reason whenever the auditor is doing the audit of financial statements, he does not only check the account balance, he does not only check the class of transactions, but he will also check the disclosures. Because if disclosures are wrong, financial statements will also be wrong. Got it? All right. Poor quality disclosure may obscure understanding of the important matters. People will not understand only what it is all talking about. Okay, then concerns have been raised about whether auditors are given sufficient attention to disclosure during the audit. The IASB believes that whether term financial statement is used in the ISAs, it should be clarified that it's intended to include all disclosures subject to the audit. I told you just now, okay, when you talk about the International Federation of Accountants and when you talk about international standards in auditing also, they all have raised concern that whether while doing the audit, is the auditor actually giving importance to disclosures? So ISAs by themselves have made it very, very clear that wherever we are telling financial statements, automatically the presumption is they include balance sheet, they include P&L, and they include notes to accounts. That means when I'm doing the audit of financial statements, we are automatically doing the audit of disclosures also. That means when we give true and fair view on the financial statements, we are telling balance sheet gives a true and fair view. We are telling P&L account gives a true and fair view. And we also tell notes to accounts are also giving what? True and fair. So the ISAs, it should be clarified that it is intended to include all the disclosures subject to audit. That means anything that is connected to the financial statement, disclosures about that also will be checked by the auditor. Only then he can give opinion. So don't you think you need to obtain evidences even to understand whether disclosures are correct or not? Yes. Recent changes to ISAs include emphasis on the importance of giving appropriate attention to the addressing disclosures. Nowadays, trust me, disclosures are given most importance. Okay, because when you say it has to be, corresponding to the financial reporting framework, legally, many things have been given where disclosures play a very important role. Okay, then focus on matters relating to disclosure to be discussed with those charged with governance, particularly at the planning stage. So today, when we have a first discussion with the TCWG, okay, at the time of doing a planning and understanding about the entity, environment, the structure, everything, that time we also talk about all the disclosures. Then emphasis on the need to agree with the management that they are responsible to make available information relevant to the disclosures early in the audit process. So we tell the management that look, whatever you need to disclose, the information has to be made available early in the audit process. That means don't come and give it at the end. Where there are mandatory disclosures to be done by you, you have to do it initially only. Do not postpone it to the end. Disclosures are very important part of our audit. And that is the reason we want you to do everything at the early stage of the audit.